Imagine a massive financial institution, a titan in the industry, holding assets that look valuable on paper but are incredibly difficult to sell quickly. Lehman Brothers attempted to manage its illiquid asset risks primarily through a combination of securitization, off-balance sheet financing, and hedging strategies. However, these methods ultimately failed to protect the firm when the market for these assets collapsed. At the heart of the issue were illiquid assets, especially mortgage-backed securities, many of which were tied to subprime home loans. These assets are considered illiquid because they cannot be easily or quickly converted into cash without a significant loss in value. For a firm like Lehman, whose business relied on borrowing short-term to invest long-term, holding too many of these assets created a severe mismatch. When the housing market deteriorated, the value of these securities plummeted, and there were virtually no buyers, making them effectively worthless and trapping Lehman's capital. Lehman's management tactics included creating special purpose entities, or SPEs, to move these assets off its main balance sheet, making its financial position appear stronger than it was. They also engaged in complex hedging strategies, using financial instruments like credit default swaps or CDSs to theoretically offset potential losses. Furthermore, they held what they believed were diverse portfolios of these securities, hoping that not all parts of the housing market would decline simultaneously. An interesting detail from this period is the widespread use of repurchase agreements, or repos. Lehman and other firms relied heavily on short-term repo markets for liquidity, using these illiquid assets as collateral. When the market lost confidence in the value of the collateral, this vital funding source dried up, accelerating Lehman's downfall. Ultimately, Lehman's attempts to manage its illiquid asset risks highlight a critical lesson in financial history. The perceived effectiveness of risk management strategies can quickly evaporate when underlying market conditions shift dramatically and investor confidence vanishes, turning seemingly valuable assets into unmarketable burdens.